Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. Today, I have the pleasure of welcoming Ted Lanzaro with Lanzaro CPA. Ted is a certified CPA, and he is an investor, an accountant, an author, a speaker. Boy, I mean, Ted has a lot of experience into tax strategies for businesses and high net worth individuals. Being an investor to himself, it gives a lot of great perspective for Ted to kind of see the panorama of what investors deal with on a daily basis. He has been a veteran in the industry for about 30 years now. He is the author of Tax Smart Landlord, wherein he has laid down several strategies of how to save taxes and what are the best practices for doing business from a taxation perspective. So with that, Ted, I want to welcome you to the show, and I'm honored to have you on. For listeners who may not have heard about you, give us some background to them, please.
Oh, well, first of all, thank you for having me on. It's always my pleasure, my honor to help any group of real estate investors with some knowledge. So I got started somewhere around 2002. A friend of mine came to me and he's like, I was working as a CPA in a real estate department of a big firm. And a friend of mine came to me and he says, we got to start buying properties. You got to read this book. And the book was Rich Dad, Poor Dad by Robert.
Sure.
And I think a lot of investors have read that book. And I read it and I was like, this is really cool stuff. As a matter of fact, I was telling my friend, as a matter of fact, a lot of my real estate investor clients are really doing well. I think you're right. I think we should, go out and buy some properties. And so he and I, we were living in South Florida at the time. And he and I went out. And the first day we went out, we put offers on 3 single family houses in Fort Lauderdale, Florida. And we bought them, eventually bought them, we fixed them up, and we rented them, right? And that was the beginning of our sort of real estate, investor career. That particular partnership ended up turning into about a dozen single family houses and a couple of apartment buildings. Nice. And around 2005, as the market was getting hotter and hotter, we decided to sell all those properties. We sort of cashed out. And I moved up here to Connecticut, and I started my own investing firm here, buying multifamily properties and doing some flipping and rehabbing. Somewhere along the way, I was networking at a real estate investment club, and somebody found out I was a CPA, and they said, well, what tax strategies are you using for your investments? And I said, well, here's a couple of things that I'm doing. Oh, would you mind doing a presentation for our group? And there was a group of real estate investors in Port St. Lucie, Florida, and this guy had a group up there. And so I went up there and I spoke to the group, and I had never done a presentation before. And I literally sat there with my knees knocking together and reading off my PowerPoint slides, And but at the end, everybody clapped, and a bunch of people talked to me, and I picked up a few clients, and I was like, this is great. Now I literally I probably do 6 or 7 of these things a month. Right?
Nice.
and I can't remember the last time I only use slides if people ask for them.
Sure.
And, because I literally do, I have 4 or 5 presentations that I literally do off the top of my head now. But that first time, man, it was scary. And it led to, after years and years of dealing with and helping real estate investors save money, I decided, I'm going to put all of these things that I've learned into a book for investors.
Sure.
And so somewhere around, I guess, 2014 or 2015, I wrote the Tax Smart Landlord. It's been updated a number of times since then as the tax laws change. So every time we have a major change, I have to go in and update it.
Sure, sure.
But, it's turned into a really nice way to share knowledge,
Sure.
with a lot more people. So even the people that I don't personally do work for, I can still share knowledge with them. And it's really
Sure, sure. No, I think, and thank you for that, Ted. I mean, I always like to say that veteran investors like you and who've been dealing with tax issues and from a certified CPA background, you come up with a lot of professional things that normal investors wouldn't, structure it and things like that. And it's always a great thing because, I mean, I'm myself a realtor and I've been operating full time. And I can see those different classifications that we will talk about. It makes such a tremendous difference that if you're not knowing, and I always like to say that real estate can be used as such a great hedge, So with that, Ted, if you can maybe help us understand, how different tax laws we can use and how a different classification of investors can perhaps impact how you're saving and, sort of taking deductions on your taxes.
Sure. Okay. So let's with this. Everybody is different. Okay. So not only are there going to be different classifications of investors that we'll talk about in a minute, but every investor has their own profile. They have,
Sure.
They have a W-2 job, own a business, are they married, single, what are their goals, right? Because not everybody's goal is complete tax minimization.
Sure.
How many properties do you own? Do you actively manage? All of these different things, right?
Correct.
So when I'm in a room of 25, 30 investors, say, for example, a strategy that one of them would be great for one of them would be awful for somebody else.
Sure, sure. Mm-hmm.
Right? So essentially, there's three kinds of investors according to the IRS, right?
Mm-hmm.
So the first one is passive investors. And what this refers to is the ability to deduct rental losses against your ordinary income.
Mm-hmm.
Okay. So a passive investor is somebody who invests in somebody else's deal.
Mm-hmm.
They don't have any management control. They're not involved in the operations of the investment. They could be anything from a silent partner, like just me and you doing something together and you're going to run it and I'm just going to give you some money for a return.
Sure. Mm-hmm.
All the way up to a large syndication where there's a limited partnership or an LLC that has, 15, 20, 30 limited partners and a couple of general partner operators that found the deal.
Mm-hmm.
The people who just invest for a return without management control are considered passive investors,
Sure.
and they are not allowed to deduct rental losses against their ordinary income.
Interesting.
Now,
mm-hmm.
what happens is those losses accumulate as what's called a passive loss carryover, and they carry over from year to year. And they can be used in one of three instances, okay?
Mm-hmm.
So they can be used to offset other rental income or other passive income that the taxpayer has in a given year.
I see. Only the rental income, not like your W-2 or anything, basically.
Not your W-2, other rental income or other passive income. Okay?
Gotcha.
Or they can be used in a scenario where somebody's income falls below $150,000 a year, and they're an active now they're considered an active investor, and we'll talk about that in a minute. Well, then they may be able to use those loss carryovers against their ordinary income up to $25,000 a year. Or when you sell the property, then you use all of the passive losses that you carried over from that property. So you never lose them. It's just more of a timing of when you get to use it. So that's passive investor.
Right.
An active investor would be somebody like yourself, for example, who owns a lot of units that they manage themselves.
Sure.
Right? And what the law says is if I'm an active investor, I can deduct up to $25,000 a year of rental losses against my ordinary income, assuming that my adjusted gross income does not exceed $150,000 a year.
I see.
If I make $100,000 a year, and I own a bunch of rental properties and I have a $25,000 rental loss, well, then I can offset that rental loss and only pay taxes on $75,000, 100 that I earned minus 25 that I lost on my
Sure.
investment. Now, when I say losses, I want to clarify this for people. I don't mean that your property actually loses money, right?
Sure.
There's a concept called depreciation expense,
Sure.
which is basically a rational allocation of the purchase price of the property that you get to take every year against the net operating income of your investment. So the idea, the whole reason people invest in real estate is so they can have the cash flow
Right.
from the property, but it's offset by the depreciation expense, and therefore they have no taxable income.
Right.
And then, so it's tax-free cash flow.
Sure.
Right?
Sure.
Now, what happens is for an active investor, if their income goes above $150,000, and this is what happens to a lot of professionals who are also, own their own properties, is their income goes over $150,000 a year, and at that point, they're treated as passive investors, okay? Because now they can't deduct any of their rental losses because their income's too high. It's called a phase out.
Right.
Okay.
So meaning you're referring to professional, basically professional status there.
I'm just talking about active right now.
I
So
see.
If I'm an active investor and my income goes over $150,000 a year, then I'm either considered a passive investor most of the time, or can qualify as a professional. Then I may try to qualify as a professional because that's the way out. Like once your income goes over $150,000 a year, if you're an active investor, then you want to be able to qualify as a professional because that's the only way you're going to be able to.
Right. If I may there, Ted, so once the income goes about $150,000, you're saying that, for lack of a better term, you are a high income earner at that time, at that point, and hence you are considered passive, and perhaps you are liable to a higher tax bracket. Is that kind of what the IRS is deeming that to be?
Right, exactly. That's exactly right. So the IRS says, well, once you hit 150,000, we're not going to allow you to deduct rental losses anymore.
I see.
Got it. And look, I mean, we can argue all day whether that's a stupid rule or not. I think it is, but but it is, right? So now, in order to be able to deduct those losses, you have to be considered a professional. A real estate professional is somebody who is in a real estate related business. Okay. Could be brokerage, could be property management. You could just be a landlord. You could be a developer or syndicator. There's a whole bunch of categories, right?
Sure.
And if you put more than 750 hours a year into that business and it's more than half of what you do, then you can qualify as a professional. And as a professional, I now can deduct as much rental loss against my ordinary income as I possibly can. So I've got a client who's a real estate broker. He makes about $600,000 a year, okay? Owns a bunch of apartment buildings. Every couple of years, he buys a new one. So last year, he bought a new property, and we did a cost segregation study on it. And he got a cost segregation study. It's a depreciation study that breaks out the components of the property and allows you to accelerate depreciation, especially in year one. Where there's a rule called bonus depreciation.
We'll definitely get into that as well, Ted.
So in this scenario, my client had $200,000 worth of depreciation in year one. So he was able to take his $600,000 of income because he's a professional and deduct $200,000 of rental losses. Then he also made a $125,000 retirement plan contribution. Okay, so in that year, he only paid taxes. He made 600, but he only paid taxes on 275.
I believe that. And I mean, there are extreme cases also, Ted. I mean, I'm an example of that, where sometimes, I'm draining this whole thing to like zero and just sometimes not even paying a tax. I mean, here I am owning a couple of hundred houses, and first-hand example of seeing that how much deductions and depreciation you can take. It's absolutely unreal. I mean, it's just like if you tell someone who's not intelligent or not knowing the sort of the depths of how you go on to achieve it, it's absolutely mind-blowing. And this is the information that I believe that I think every single person ought to know, because everybody's paying tax. And if you can lower the tax or even eliminate the tax for that matter, there's nothing wrong in it. And IRS, in my opinion, has made these rules just for some of these provisions that are there, right? And now, speaking of Ted, all these, like, how can be different strategies you can have for, let's say, if someone is a high income earner, earning lots of money, what are some of the ways you can suggest that they can go into it? I mean, they cannot become professional, for example, or is there any way out they can look into this?
Yeah. So there's a handful of things that you can do as a high income earner investing in a passive capacity, right?
Mhm,
If
mhm,
I invest $100,000 into a syndication, right? And
mhm.
let's say I'm going to get an 8% return, just as
Sure.
an example, right? So
Mhm,
now I'm going to get my $8,000 a year,
mhm.
okay, distribution. Now, so at that point, I'm getting tax-free cash flow. Okay,
Sure.
I'm
Mhm.
getting my $8,000, but I'm also getting a K1 with a negative number on it, right?
True,
So
true.
now I can't take that. Maybe I can't take that loss, but I've still got the 8,000 tax-free dollars, right?
Sure.
So
Mhm.
now what I can do with that 8,000 tax-free dollars is I can see whether or not I can find another deferral mechanism for my salary, right?
Mhm,
So maybe I haven't funded my 401k at work yet.
mhm.
Okay, I put the $8,000 into my 401k at work.
Sure.
Okay.
Mhm.
So what is it? I didn't deduct any rental losses against my ordinary income. But what I did do is I reduced my ordinary income by deferring money into a retirement plan without changing my financial situation. I
Sure.
had an extra $8,000. I used it. If I'm a business owner, I can do the exact same thing.
Mhm,
I can put that money into a self-employed retirement plan,
mhm.
and again, I've reduced my ordinary income. I can make a spousal IRA contribution for my wife or my
Sure. Mhm,
husband.
mhm, mhm.
And again, I've reduced my ordinary income. Or I can contribute to a health savings account if I haven't maxed out my. So one of the things we do with high income earners is just making sure they're maxing out all of their tax deferred vehicles
Sure.
with the extra cash flow they're getting from their passive investments.
Right,
Right.
right. So these are all definitely deferrals. There is nothing as such that, how we can, as a professional, you can use all the depreciation deduction you can do. There's nothing of that sort for high income earners. Is that kind of, would that be
That,
a right statement?
yeah, that's correct. That is correct. But think about it from this standpoint, okay? It's still a huge advantage. You're still getting tax-free cash
Sure,
flow, and to the extent that you can fund a deferral, it's actually a double bang. I'm getting tax-free cash flow and a tax break, right?
sure. Mhm.
Now, and the deferral is typically going to be a pretty long-term deferral. It's going to be at least 5 to 7 years until they sell the property. And if I fund a retirement plan, that may be a 20 or 30-year deferral of that money,
Sure,
right?
sure.
So
That's huge.
there's a lot of time value there. The
Absolutely.
other thing I can do is I can also, if I'm an active investor, right,
Mhm,
with my own portfolio,
mhm.
I still can use I can still use the rental losses from the passive income to offset my rental income from my other rental investments. So if I
Sure,
have $50,000 of net income from the properties I manage and a $50,000 loss on my K1 from my passive, then those net out.
sure. Mhm.
And now I
Sure,
pay zero tax on the other money I earn. So
sure.
that's another strategy. And then the third one that I often talk about is if I'm a passive investor, and this one's really important, right? It
Mhm.
involves some record keeping and some responsibility. But think about
Sure.
what we talked about before. I'm a passive investor. I'm in a deal. I'm going to be in that deal, let's say for 5 years,
Mhm.
and I'm going to get my in this scenario where I invested 100, and I'm going to get my 8% return. I'm going to get my $8,000 tax-free dollars every year, right?
Sure. Mhm.
And then in year 5, when the property sells, hopefully it's going to be for a gain, and I'm going to get my piece of the gain also,
Sure.
right?
Mhm.
Now, what happens is that accumulated passive loss carryover offsets the capital gain.
Sure.
And I only pay tax on a small portion of it, and it's long term, so I only pay tax at 15%.
Sure.
But now what I want to do is all the money that I spent, find that passive deal. And a lot of passive investors, they go to conferences, they travel to look at properties, they network, they take people to lunch, all of these different things. I'm going to tell you, you need to be keeping track of those things. And you need to be adding them to the other deductions line on your K1 and increasing the passive loss carryover. So let's say, just as an example, I had, without any of this, I sold I had my $100,000 investment. When it sold as a capital gain, it was really, they sold it for $150,000. So now I have a $50,000 gain, right? I have a $90,000 carryover. I'm going to pay tax on $60,000. Okay. Well, but if I have been adding all of my expenses for finding properties, and let's say that's another $3,000 a year. Well, at the end of 5 years, I've got an additional $15,000 carryover. Okay, which can then be applied against that capital gain. So instead of paying tax on $60,000 of capital gain, I'm only paying tax on $45,000 of capital gain. And all I did was keep a spreadsheet every year of the money I spent looking for passive investments.
I see. Now, related question there, Ted, is that, you said keep a record of, all the expenses you would have done for whether it was conferences, books, and finding properties and things like that, right? So let's say year 1 through 4 or something like that, But what if you would have already itemized those expenses in the preceding years? How would we go about that? Or should we not take advantage of those? Like generally you have the deduction for, let's say, educational items or home office and things like that, where, you typically kind of allocate that bucket, right? So are you saying that don't allocate there? Just keep a record and accrue it so that when you're expecting this capital gains from the sale of the property, you can use these expenses and sort of offset that. Is that what you're referring to?
Well, what I'm saying is, if you had nowhere else to deduct those things,
I see.
Right, then add them in.
Sure.
Now, let's do just as an example, right? So let me say this. So maybe I'm a doctor, or I'm a CPA. Let's use me as an example. I'm a CPA, right?
Sure.
My primary business, I invest passively, which I do, right?
Now,
for me, I'm not going to allocate a portion of my cell phone bill to my passive investments. Like you wouldn't allocate a portion of yours to your real estate.
Sure.
But so I'm going to try to deduct that. But if I didn't have any place else to deduct that, maybe I'm a W-2 employee and my boss and my company pays for my cell phone, or I never even think of deducting my cell phone, right? Well, then I don't have any place else to deduct it. So I'm going to put it in that passive bucket and increase my passive loss carryover. If I have someplace else to deduct it that will benefit me in the current year, I put it in that more beneficial bucket. But some people don't have that bucket, and that's what I'm talking about when I say everybody's different, and we try to tailor what we're doing to everybody's specific situation. So for some people, that's a very viable strategy.
Sure. Now, Ted, let's talk about the depreciation, the bonus depreciation, and cost segregation, all of that, right? A lot of passive investors sometimes do not understand that yes, your cash flow is coming tax-free, and you are getting K1, which obviously is negative. Can you maybe talk about how depreciation perhaps brings you the negative and the sort of the offsetting factors that come into it, and why IRS has it? Because as I indicated, a lot of passive investors do not relate that, oh, I can make the cash flow and at the same time, oh, I can get a K1 that has a negative number on it. Can you maybe speak to it, please?
Yeah. So think about it from this standpoint. I wouldn't invest in any real estate venture, whether it was a syndication or just buying my own property, if I thought it had a lot of negative cash flow. There's sometimes you might want to do that, but
Sure.
as a general rule, you don't invest for negative cash flow. You always
True.
invest for positive cash flow, right? So now I've got this positive cash flow, this net operating income for the company. And normally I would just pay tax on that. If depreciation didn't exist, then I would just pay, that would be my net income and I would pay tax.
Sure.
But what the IRS rules say is you're allowed to depreciate the property. You have to depreciate the property.
Sure.
And typically the depreciation on a residential apartment building or residential rentals, the IRS says the building is depreciated over 27 and a half years. If it's a commercial building, it's depreciated over 39 years. Okay.
Right.
So if I bought a building for $3 million, I would typically allocate 80% of it or more to the building. So let's say 80% of 3 million is $2.4 million of building cost. I'm going to depreciate it over 27 and a half years. So I'm going to get somewhere in the neighborhood of around about $90,000 a year of depreciation for that property.
Sure.
So if I have $90,000 a year of net operating income, I now have zero taxable income because I've offset depreciation.
Right.
Now, if I do a cost segregation study, which is a depreciation study that's done by an engineer and an appraiser, and they go in and they basically break out the components of the property. So think about an apartment building, right? Let's say there's 100 apartments in a building. Every one of those apartments has a kitchen, a bathroom, probably bedrooms with closets. So everything, the IRS says that everything that I can unplug, unattach, unscrew, and literally take away with me is what's called tangible personal property.
Sure.
Tangible personal property can be depreciated over 5 years. Okay. So think of those kind of things: cabinets, sinks, appliances, toilets, tubs, vanities, mirrors, shelving, anything I can literally unscrew and walk out the room with, right? Those are 5-year property. So that's what the cost segregation engineer is doing. He's identifying all that 5-year property. Then he's going to go outside and he's going to look for what's called land improvements. Land improvements are things like the parking lot, fencing, curbs, sidewalks, not the one in front of the street, but the ones that run from the parking lot to the door of each unit, right? All of those land improvements, landscaping, are considered 15-year property, and they can be depreciated over 15 years. So typically, in a scenario like an apartment building, the national average is around 25%. So you're typically going to get around 25% of the cost of the building is going to be either 5-year tangible personal property or 15-year land improvements, right? So now, to make it even better, so that would ordinarily just be great. I could take a portion of it and divide it by 5. That would increase my depreciation. And now, instead of taking $90,000 worth of depreciation, I might be taking $200,000 worth of depreciation. Okay?
Right.
At least for the first 5 years,
Right.
until the tangible personal property is used up. Now, to make it even better, there's a concept called bonus depreciation. So for every dollar that's allocated to either a 5-year tangible personal property or 15-year land improvements, the IRS says in 2019 that I can take 100% of that depreciation in year 1.
Wow.
So now, on let's say that's $2.4 million building, we allocated 20% of it. Maybe we have somewhere in the neighborhood of about $500,000 of tangible personal property. That partnership gets $500,000 of bonus depreciation in year 1.
Wow.
Same thing for the land improvement. So they're going to end up with somewhere around $600,000 of combined bonus depreciation in year 1. Now, if I'm a limited partner in that, and I own, say, 1% of that, I'm going to get 1% of that $6,000 bonus depreciation allocated to my K1. So I may have $8,000 worth of cash flow, but my K1 says negative $6,000.
Sure.
Right?
Makes it extra sweet.
Right, exactly. So that's typically how the depreciation is used to offset the net operating income. And again, I'm going to have depreciation in year 2, year 3, year 4. And so typically for at least the first 5 to 7 years of a syndication, most of the time the passive investor will never see a positive number on their K1.
Right. Awesome. And there's a stat out there, Ted, I think, and as you're alluding to, is that first 3 to 5 years are easily in the negative, and that's when I think business plans are optimized to say that, yes, maybe consider a sale from year 4 through 5, because that's when your all of your depreciation is kind of coming to a zero, and then you're going in the positive territory. Does that make sense, Ted?
It does, yeah, and a lot of them are also 5 to 7 year plays, just because it's hard to talk people into parting with their money for longer than that. They want to be into a 5 to 7 year play as opposed to a 20-year play.
Sure. Now, speaking of all the daily practices that we do from a from a full-time investor basis, or syndicators who are doing different activities, what can you tell Ted about how best we can keep our bookkeeping and records and things like that, so that in case of an audit, we kind of have a trail of various things that we have done? Can you maybe share some insights around that?
Yeah, I totally can. And it's not just you obviously audit proofing is definitely a consideration, but the other thing is that all good tax strategy is built on a foundation of good record keeping, right? Because when I'm doing tax planning and strategic tax strategy for investors, I need them to be able to give me good numbers. Right? Because if they can give me good numbers, they can tell me, look, these are the P&Ls on my property. So like if you have your 200 properties, you hand me your P&Ls and I can tell how much money you made. Sure. And if you handed me nothing, then I'd be guessing, right?
Sure.
So by giving me the actual numbers, I can do a much better job of strategy. So now with that being said, I think when you get to, if I own 1 to 5 properties, then I would say to you, whatever way that makes you comfortable. Like, I would say, okay, if you like QuickBooks, that's great. If you like any of the other, more property manager kind of software is great. But for the people that own 1 to 5 units, they could probably do it on a spreadsheet, right?
Sure.
And as long as they're getting everything, that's my big concern. Are you getting everything? Are you recording everything that went in and out of your bank accounts, in and out of your credit card, in and out of your loan statements? That if you're getting all that, I don't really care how you're doing it. Now, once I get over that 5 units, or and I have 200 units, well, then I think you can't keep track of who owes you money in your head anymore.
Sure.
Right? So now you're going to need something a little bit more robust, whether that be a Appfolio or Buildium or Yardi or whatever. There's a whole bunch of these softwares out there that are sort of combination management and
accounting building, right.
And those are really advantageous for larger investors. Now, but they all have one thing in common. They're all garbage in, garbage out programs.
Sure.
You got to make sure that you're putting the right information in.
That's exactly true. Like how you classify, and that was going to be my follow-up question as well. That here is that like the classification of how you're entering the data. Like sometimes like I can tell. Having done this on a daily basis now, that we'll get a log of what things maintenance have fixed, right? So, and our CPA always advises, and I'm curious to hear your thoughts as well, as to how important it is to properly classify whether it's a repair or replace or a fix and things like that, and how those things add up cumulatively annually. Can you maybe speak to that as to why it is so important to properly do those classifications?
Yeah, well, so there's a difference. So we'll start by clarifying the difference between a repair and a capital improvement.
Sure.
A repair I can deduct in the year I pay for it.
Right.
Okay? The capital improvement has to be added to my depreciation schedule, and is typically going to be depreciated anywhere from 5 to 27 and a half years, right?
Sure.
So I may not get the immediate benefit of that improvement, right? So the IRS says, when we come to look at your books, if you recorded something as a capital improvement on your books, and then decided to make it a repair on your tax return, you're giving us more ammunition
to question you, right?
To question you and reclass it back as a capital improvement, because that's how you classified it at the beginning, right? So it's really important. So two things. One, it's really important how you classify things on your books, because you're better off always classifying things as repairs and then capitalizing them as improvements if you have to, than the other way around.
I see.
The second thing is that you really should, as a landlord, I'm sure you are, but for all the other landlords out there, you really should become very familiar with the IRS's definition of repair versus capital improvement. Because there's 5 or 6 years ago, the IRS revamped what's called the Tangible Personal Property Regulations. And they said that there are certain things that are always considered repairs.
I see.
Okay.
Give us some examples on that, Ted. I'd be curious to know.
Yeah, heating and cooling, roofs,
sure,
right? Painting, carpet replacement,
sure,
right? Okay, those are all considered repairs. A lot of people capitalize those things. Parking lots, you repave a parking lot. A lot of people would capitalize that. IRS says that's a repair.
Interesting.
Right? And it's right on. It's literally right in those regs. There's a whole list. And I share that. So what I did was, when I did the Tax Smart Landlord book, I also did a series of spreadsheets and like a tool, what I call a toolkit for investors. And one of the forms that was in that is a list of all things that are always considered a repair. And I can't tell you how many times I've shared that list with investors, because it's such a valuable list. Because I see a lot of that kind of stuff being capitalized on returns that I get when people call me and say, "Hey Ted, I'm looking for a new accountant. Can you take a look at my last year's taxes or whatever?" And I go to look at the depreciation schedules, because it's one of the first things I would look at.
Sure.
And I see a lot of those items on there, and I'm like, oh, there was a missed opportunity. That could have been expense. You could have saved more money in that year.
Sure. Now that's interesting, Ted, that you're saying some like an item like roofing, for example, is a repair and not a capital improvement. That is quite interesting, because typically, as we know, roofing, once you replace, it will last you for at least 10-15 years if done right. But you're advising that it should be classified as a repair. That's an interesting one.
Right, and it used to be so before. So yeah, it is interesting, and it doesn't really make any sense, to be honest with you. Right? Well, when you look at it, it doesn't necessarily make any sense, because it used to be, right, before they did the regs, before they revised the regs, it used to be, if you the old rule was, if you fixed a portion of the roof, okay, then it was a repair. If you fixed the whole roof, like if you did a rip and reply on a roof, on a small house, or if you literally redid the roof on a larger building or something, and that was a capital improvement, right? And they're often very expensive.
Sure.
It's on the list. Don't ask me why it's on the list, but it's on the list.
That is a new one for me personally, for sure. So yeah. I appreciate you sharing that, Ted. Now let's talk about how someone can kind of leapfrog from one property to a bigger property, as we call a 1031 exchange. Give us a rundown of what it is, what are the sort of some of the motivations behind it. Take it away, Ted, on that.
So look, as an investor, it's, I think, probably the number one tax strategy for growing wealth as a real estate investor. Because if I can sell a property without paying any income tax on it, it gives me more money to be able to reinvest, faster. I'm going to get wealthier faster.
Sure.
So I had a client of mine. We'll talk about the rules in a second, but I had a client. I'll use this as an example.
Sure.
I had a client of mine, and he was a plumber. And for the 10 years of he was like 30 years old when he started. And for the first 10 years of his plumbing business, he would use the profits to buy small rental properties in and around South Florida. This is back in the late 90s. Okay. So he built up a portfolio over about 10 years. He built up a portfolio of about $1 million worth of property, a lot of small units and whatnot, right? So he goes in about 2001, right? He goes and he sells his entire portfolio for $1 million. And he had paid around $500,000 for that portfolio. Sure. So he had about a $500,000 capital gain. Okay. And he said, well, I'm going to sell my properties. I don't want to pay the tax. What do I do? I said, well, you should do a 1031 exchange. Well, how do I do that? Okay, well, here's what you're going to do. You're going to arrange to sell the properties. Before you close, we're going to hire somebody called a qualified intermediary. You're going to have 45 days to identify a new property and 180 days to close on it. Okay. And if you buy another rental property to rental property, then that's considered a like-kind exchange, and that's the whole idea of the Section 1031 exchange. Now, like-kind means rental to rental. So it could be, in his case, he went from residential to commercial, because he actually bought a commercial shopping center on a main road in South Florida, and he spent 2 years. So he bought it for $1 million, what he sold his portfolio for. And over the next year, he put another $1 million into it, fixing it up.
Sure.
And he put new tenants in it, got it all leased up. And every time I drove by there, he'd be out there working on it and everything, right? And then a couple of years later, so now it's like about 2004, right? He turns around, he gets an offer for $3.5 million.
Nice.
Rising market in South Florida at the time, right? Very hot market. So now he's got like $1.5 million in this thing, right? He's got about a $2 million capital gain at this point, 500 from the first one and $1 million that he put into the second one. And I guess he bought, so he has about $1.5 million in this. He's got about a $2 million capital gain. And he's like, well, I don't want to pay the taxes on $2 million. What do I do? I said, well, we're going to do another exchange, right? So he goes out and he sells his property, and he turns around and he buys 6 auto zones in Texas, right? Triple net leases, right? Long-term, high credit thing. He paid $5 million for this property. So he actually added some of his own money into it, in form of a loan. But now he's got triple net leases, no management. He gets about $40,000 of net income every month.
Wow.
And at the time he was 40 years old. So that was 2005.
Nice.
Right? So he's making almost $500,000 a year doing nothing. Right? He hires from plumbing. Right? Now, so I said to him, I said, well, look, I said, you're not gonna have to pay this capital gains, until you ultimately decide to sell these. He said, I'm never selling these. So are you kidding me? He's like, I'm going to give these to my kids when I die, right? So what happens is when you pass away and you own a bunch of property, right? You get what's called a step up in basis as of the date of your death, right? So whatever the fair market value of those properties are at the date of your death, that's the cost basis to your beneficiaries.
I see.
Right? So now, I don't think he's died yet. I haven't seen him in probably 10 years, but I don't think he's died yet. And so when he does pass away, that capital gain that he owed, that he's been deferring forever, goes away. And if his kids sell that property literally the day after his funeral, right, no capital gains on the property. So he's laddered up his properties, built a tremendous amount of wealth, and never paid a dime in taxes. Right? And that's like sort of the ideal scenario.
No, absolutely. That's right. I mean, that's a great story right there, Ted. Now, a couple of questions around it, Ted, is like, let's say you buy a property A, and you sell it, you go into a property B. So for example, in your scenario, your plumber, when he bought the second property, right, he fixed it up and things like that, and then sold it for a higher for a higher price, right? So the basis that we are calculating here, is that the purchase price plus the amount of renovation he did, or is it just purely looking at the hard one saying, okay, you bought it only for whatever price, and that's your basis? How does that come into play?
The basis of the property you sold carries over to the new property, right? So it doesn't, in his scenario, he had let's say he had $500,000 of basis. He sold it for $1 million. He went and he bought another property for $1 million. But his basis is still only $500,000, the carryover from the previous property.
Right.
Now he goes and he puts another $1 million into renovating it. So now his basis in that property was $1.5 million, and he sold it for $3.5 million. So he had a $2 million gain. When he went into the auto zones, his basis was $1.5 million.
I see. So any improvement dollars that you would invest, effectively you're saying they do not count towards the basis. Is that what you're saying?
They count towards the basis. They get added to the basis.
They will.
Scenario,
okay.
That $1 million that he fixed up the shopping center added to his basis. So his basis went from 500 from the previous property plus $1 million he put into the new property. Yeah.
I see. Got it. So all of them definitely count. So it's really what you invest is what counts, and they get added on. Okay, that's powerful. That's absolutely powerful.
Yeah.
And another related question that Ted is that the newer property has to be obviously greater than whatever is your selling price. Is that true, or can you not do like a half and half, meaning perhaps you're not going that much higher, you're just maybe going a little lower? How does that work?
If you want the entire 100% deferral, then you need to buy a property of greater or equal or greater value.
I see.
So, okay, I can't find it. This happens all the time. I can't find a property of greater or equal value that I want, right? So I buy a property, and let's say it's 50% of what I sold. Well, I can do a deferral on half, and I can pay the tax on half.
I see. Got it. So the proportional deferral is allowed, you're saying?
There is, yeah. You're allowed to do a proportional deferral. Now, with that being said, there are a lot of rules with this. And there's a lot of ways that you can end up with what's called boot or taxable gain in a scenario, right? It's a little heavy for a podcast, but
I know we would probably go into those. Right. We probably wouldn't have wade into those waters for sure.
Yeah.
Now, a couple of last questions, Ted, here. As we know, CARES Act came with a lot of good incentives for individuals and businesses, right? Can you maybe talk about some of them? And specifically, I'm interested for viewers to know, like how some of the operating losses can be carried over, or perhaps some of the improvements that you can do can be, carried over as well. Can you maybe speak to that?
Okay. So there's really like a couple of different issues here.
Sure.
One of them is that for commercial property owners, right? And this is people who are primarily so what they said was qualified leasehold improvements are now 15-year property. And because they're 15-year property, they're subject to bonus depreciation, right?
Nice.
So that's issue one, right? Now, you're not going to find those in residential apartment buildings.
Right.
You're going to find them in shopping centers, office buildings, mixed use kind of stuff. Okay.
Sure.
But if you own those, restaurants, hotels would have those things.
Sure.
Right. If you're in that business, right, then you have those, right? And then now you've got this bonus depreciation that you can take. So then the second issue is, if I have bonus depreciation that exceeds my ordinary income, creating what's called a net operating loss.
Right.
Okay. Meaning that I actually have negative income for either 2018 or 2019 or 2020.
Sure. And that's
Right?
all a paper loss. Let's put it that way as well.
It's a paper loss, but
Right.
it's literally negative income on your tax return.
Sure.
Okay? Right? Because your losses exceed your income at that point. Now, instead of having to carry them forward pre-COVID, okay, with the CARES Act, I can now carry these back 5 years.
Interesting.
But when I do it, I have to start with the farthest year, right? So think about if I do it in 19, 18, 17, 16, 15, 14.
From
So I have to start with 2014.
Correct.
Right? So now here's kind of an interesting thing. Think about it. So I've got a guy who actually has this scenario, and he's got about $500,000 loss that he needs to allocate, right? So he says, well, let's do a carryback, right? Well, in 2014 and 2015, he wasn't making that much money, right?
I see.
So he can go back and he can knock out $100,000 of income in 2014, and $100,000 of income in 2015, and another $200,000 of income in 2016, and $100,000 in 2017, right? And let's say the benefit of that is that he would save $100,000. Okay, you get $100,000 refund.
Sure.
Right? And he's like, yeah, well, great. Oh, wait a second. Next year, you're going to have over $1 million worth of income. And you carry it forward and take the whole thing against that $1 million worth of income, you might have $150,000 net benefit.
Sure.
So the point being is you have to look at the options. You have to carry it back mentally, figure out what the recovery would be, and then carry it forward and figure out what the recovery is going to be in order to make the most optimal use of that loss.
For your scenario. So it depends, I guess, what has happened in the prior years, if it makes sense to carry it back, or perhaps, you know, if it makes advantageous sense to go forward, meaning carry forward, basically.
Right, because just because you can doesn't mean it's the best possible use.
Sure. Absolutely. Boy, it's been a ton of, information and great content, Ted, here. Any other tips you can share before, I mean, we're almost at time for the show, but I appreciate if there are any other tips you can share from your vantage point.
Yeah, I tell people, look, you should be talking to your CPA before you buy a property, before you sell a property, and before you renovate a property. Okay.
I see.
Definitely before the end of the year, even if you haven't done any of those things.
Right.
Because the majority of really good tax strategies have to be implemented before and during those things. When a client comes to me and says, in March of 2020 and said, hey, Ted, I sold 3 properties in 2019. How am I going to save some money?
Too late.
Too late. I mean, too late for a lot of things that we could have done. There's a few things we could do, but they pale in comparison to what we could have done beforehand. Same thing with renovations, same thing with buying, right? Because all of those things have not only an opportunity, but also record-keeping responsibilities that have to be done, that if you know about them, right, then you do them. Whereas if you wait and you didn't do them, then you lose the opportunity potentially to take advantage of a strategy that was available to you.
Sure. Great advice. And couldn't agree more that it's always best to engage, plan, strategize, and execute accordingly. And I'm always a very fan of some of the rules and some of the advantages that come with it, because knowing after the years now what an impact it can have to the bottom line, it's just simply unbelievable. And for folks who may not really have taken advantage of those, I mean, I highly encourage to engage a CPA like Ted here and take advantage. I mean, their staff is available. They are all available remotely as well. So location and any bearings, any barriers are really not an issue. So with that, Ted, I appreciate you coming on. It's been a blast knowing all the differences. I personally learned a lot as well. Kindly share with our listeners, your contact information and, different things your firm as well does.
Sure. Yeah. So my website is www.lanzarocpa.com, LANZAROCPA.com. On the website, you can get a free copy of the Tax Smart Landlord, and you can make an appointment to have an introductory call with me if you'd like. My email is ted@lanzarocpa.com. You can feel free to email me with questions. I'm always happy to help fellow investors. So that's not an issue. And my office number is 203-922-1742. And I'm happy. My practice is about proactively helping people both make and save money.
Couldn't agree more. I mean, you are such a giver, Ted. Yeah, I mean, I have viewed your prior different podcasts as well, and some of the webinars that you do. There are so many great articles on your website as well. So I encourage all the viewers to definitely take advantage of Ted's company and his services. So it's been a blast. I appreciate it, Ted. A veteran that you can come on and talk about, passive investments, the depreciation, bonus depreciation and cost segregation, and all the different things that are happening on a daily basis, and how investors can take advantage of not only the passive investments cash flow, and as well the negative deductions you can take via your K1 is incredibly insightful, and you're hearing from the authority right here. So thank you for coming on. I appreciate it. I'm sure there are a lot more things that happen, and I will be looking forward to having you on another future episode of the podcast. I appreciate your time today.
Thank you so much. I appreciate you having me. Thank you.
Thank you.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.